Hello, I'm David Frazier with Investors Monitor, and this is our daily Market Insights show where we strive to tell you everything you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your investment portfolio. Well, we're recording today's show on Friday, August 28th, and I'm sure that many or probably most of you have likely heard numerous financial market pundits, whether they be mutual fund portfolio managers, economists, or Wall Street analysts, whoever they might be, say over the past several days, and really over about approximately week and a half, that the big downturn that we had in U.S. stock prices during the past week and a half was due to developments in China, and explicitly, according to these so-called experts, to a impending, if not current, economic slowdown in China. And I find that, I actually find it laughable. And here's why I find it laughable. I'm just going to review a few notes that I've taken that you might not be aware of. Well, you probably do know, you may not know the exact points or percentage points, but the Dow Jones Industrial Average declined by 1,879 points. That's 10.7% from August 18th to August 25th. During that same period, the S&P 500 index was down 11.2%, and the NASDAQ Composite Index was down 11.5%. But if you look closely, what you'll see is that this big drop in U.S. stock prices that began on August 18th, well, that's 3 weeks after China's Shanghai Composite Index peaked on June 12th, and 8 weeks after China's National Bureau of Statistics announced on July 15th of this year that China's economy grew by 7% for the second consecutive quarter during the 3 months ended June 30th. Now, that's still a fast rate of growth, but it's considerably slower than the average rate of economic growth that China experienced between 2003 and 2012. So, China, the slowdown in China is supposedly what caused this big drop in U.S. stock prices over the last week and a half. Yet, China's central bank announced its latest GDP results, gross domestic product, its economic growth, on July 15th. One more time. That's 8 weeks before the big drop in U.S. stocks. Well, wouldn't U.S. stocks begin to turn sharply lower several weeks ago if China was behind this was behind the drop in stocks? And lastly, the late August rout in stocks that began on August 18th started 6 trading days after China's central bank announced on August 11th that it was devaluing the country's currency against the U.S. dollar by the largest degree in more than 21 years in an effort to increase exports of China goods and services. So, this just doesn't make any sense. I mean, think about it. Really? Are we really supposed to believe that the big drop in U.S. stocks is a result of a slowdown in China and China devaluing its currency, when all of these announcements regarding China's devaluation and its economic slowdown occurred many weeks before the big drop in U.S. stocks? Obviously, that doesn't make any sense. Well, and it doesn't make any sense, and in my opinion, and very experienced, and lots of experience over the past almost 30 years, actually, of speculating, trading, and investment in the financial markets, I'm very confident that that's not really what's going on here. What's really going on is that we've had a large number of leading economic indicators, not only leading economic indicators, but leading stock market indicators, turn lower several months ago, peaked several months ago and have been trending lower over the past couple of months. Now, I heard a chief market strategist of a very well-known, very large international investment brokerage firm say today that, well, the U.S. economy is in good shape, and she would not be surprised if the Federal Reserve does raise interest rates during September. And the reason that she gave was because the U.S. economy expanded at a relatively fast pace during the second quarter of this year. Well, the second quarter ended during June, okay? So that's 2 months ago. We don't. Gross domestic product, figures on gross domestic product usually are released several weeks after the end of any given quarter, and GDP, that is gross domestic product, the change in economic growth, the change in GDP, that is the pace of economic growth. This has never been a leading indicator. It's at most a coincident indicator, and given that statistics for GDP are not released for several weeks after the end of any given quarter, in a sense it's even a lagging indicator. So, the Fed's not going to look at what's happened in the past to determine whether or not it's going to raise interest rates. It's going to look at leading indicators, the same type of indicators that I review on a regular basis, to determine where the economy is likely headed in the future. So, it never just ceases to amaze me when you hear all these people. Let me look at a few other things here. I'm just glancing at several leading economic indicators. The change in the M2 money supply, building permits for new housing starts, the average work week of manufacturing production workers, overtime hours worked by manufacturing production workers, and here's what the readings on those indicators show. Well, the M2 money supply, that is the change in the M2 money supply, which is very directly related to the direction of interest rates, peaked during 2012 and has been trending lower since then. And usually the change in the M2 money supply historically has had a lot of lead time regarding giving us information where the economy is likely to head in the future, meaning historically I've found that leading economic indicator tends to peak approximately 1.5 to 2 years before a peak in an economic cycle. So that's right. That makes sense to me, because it looks like to me that this expansion that we had, we're not going to go into a deep recession, but we might go into a mild recession within the next few months. Building permits for new housing starts turned sharply lower last month, and that's been always a very reliable leading economic indicator. Tends to peak approximately 1 to 3 months before the peak in economic growth, and really right about the same time that stock prices here in the U.S. peak. So that it turned sharply lower during July. I think that's very telling. The average work week worked by manufacturing and production workers peaked during December of last year, and it's trended lower over the past 7 months. It's the same with overtime hours worked by manufacturing and production workers. Peaked during December of last year. It's trended lower over the past 7 months. The Institute of Supply Management's Purchasing Managers Index for the manufacturing sector, which is also a very reliable leading indicator, also peaked during December of last year and has trended lower over the past 7 months. I mean, I could go on and on and on. There's just, you can look up for yourself and take a look at charts of all of the indicators that I just mentioned, as well as numerous other leading economic indicators, coincident indicators. It's approximately 100 charts of these indicators posted on our website, and get an idea for yourself. I mean, you're going to see the same thing that I'm telling you. So, no, what's going on here is we're seeing signs of an economic slowdown here in the United States. And once again, I'm not one of these perennial bears. I'm not some doom and gloomer. And there's nothing that I see that would suggest that the U.S. is going to fall into a deep recession anytime over the near term, over the next 3 to 6 months. But would not surprise me if we did fall into a very modest recession, very mild recession, and if nothing less, we're likely to see a slowdown. So now let's look, or let me discuss. You can look at, once again, on our internet website at investorsmonitor.com. There's charts of many indicators, whether they be economic indicators, other fundamental financial market indicators, or so-called technical indicators and market timing indicators. We have lots and lots of indicators that we post on our website that don't cost you a penny. You can go there and look at them for free. So let me, most importantly, let me go over to one other major indicator, fundamental indicator, and that's corporate profits. Corporate profits of U.S. companies peaked during the third quarter of 2014 and moved substantially lower during the past 3 quarters. Stock prices are always determined ultimately by the level and direction of corporate profits, so that's very telling. And then if we go through some short-term trading statistics, often referred to as technical indicators. I don't like to call them that because the word technical means applied science, and I don't see anything that's applied science about these indicators. These types of indicators are statistics on the trading action in the financial markets. The price and volume action of many of stocks primarily. But let's not get too deep into that. I think most of you know what I'm talking about. But we see that the majority of these trading statistics that we follow that reveal the price and trading action in the financial markets, referred to as technical indicators. My analysis of them, and being very familiar with these statistics and monitoring them on a regular basis for more than 20 years, is that they're also telling me that stocks are probably going to trend lower over at least the next few weeks. And they gave a very clear indication last Wednesday that U.S. stocks were probably going to rebound on Thursday and Friday, and they did rebound sharply on on Wednesday and Thursday, I think it was, excuse me, and then I think they were down a bit on Friday. But these indicators suggest to me that stocks are probably headed lower also during the week ahead. I'm not going to say sharply lower, don't know, don't care. And the reason I don't care is we got our clients and investors that listen to us completely out of stocks during May 6th of this year. And people that have listened to us are sitting 100% in cash. So they haven't really been concerned about this downturn. I think I'm going to leave it at that, other than to say that I encourage you, if you're not watching this video at our website, that you go to our website at investorsmonitor.com and you take a look at a lot of these indicators that I've mentioned this evening. And there's also earnings reports, news, lots to offer there that'll give you a good idea what's going on, and you can look at the actual facts as opposed to some sell-side Wall Street analysts trying to convince you that you could keep your money in the markets. And by the way, these institutional investors, I think I mentioned this yesterday on Thursday, even though they've been telling investors to stay fully invested and not to worry, well, statistics show that they've been reducing their allocations to growth and cyclical stocks, that they did reduce their allocations to cyclical growth stocks during July and August, and that they added to their positions in so-called defensive stocks. And also, the same institutional investors, even though they've been telling investors not to worry, to stay fully invested in stocks, everything's fine, just be diversified, they added to their holdings in money market securities, that is essentially cash-like investments, during each of the past 3 months. So anyway, I'm going to leave it at that, and you should be able to draw some conclusions on some sensible conclusions on your own. Thank you for listening and watching, and I'll speak with you again this coming Monday.